Yorkseed is a global venture network for founders and investors. So we started out about 2.5 years ago. We connect founders, investors through online and in-person events. We also led delegation at major conferences. I believe funding come from anywhere. You don't really have to be based on one city to find what you're looking for.
Welcome, everyone. Can we have each expert give a quick introduction and say hello, and then we'll go right into the Q&A.
Sure, I could start. Based out of Portugal, my background has been in SaaS enterprise, mainly in business process optimization, but I also come from technical background. So previously I was a CTO at my startup, and currently I run a hedge fund called Edgecraft.
Hi to everyone. My background is technical in the automotive area, and last 10 years I'm having startups in a deep tech in the automotive and logistics with successful exit. And since last year, I'm also mentoring and consulting startups in the topics of strategic questions that they need to handle, like financial business plan, financial model, scalable processes, or just preparation for the pitch deck. You have to talk to investors based in Barcelona.
I'm the founder of Yorkseed. I am currently based in New York City and also part-time in Paris. So we do matching, we do connection between founder investors. We're building our own investor network, and we'll be actually leading a delegation to Hong Kong next week for Asian Financial Forum. We are the official partner for Asian Financial Forum. And we have a couple big hub going on right now, Davos World Economy Forum, JPM Morgan, and we'll be activating our Nordic region, Copenhagen and Denmark during Tech Arena conference as well.
My name is Ashley Martis. I'm the CEO and founder of Startup Fuel. I'm calling in from Toronto in Canada in a cold winter. I'm a 7-time founder with multiple exits. I am a VC turned VC investor. I'm an expert in valuations. I've been helping audit VC funds for the last 10 years. I've traveled to around 1,000 conferences around the world in 52 cities, meeting 100,000 people in tech. And we've been designing in Moody's or Equifax in global venture capital, trying deals with Techstars, the World Bank, Sony Ventures, and the list is going on. But right now, our entire goal is to bring some structure to this chaotic global innovation ecosystem.
Hi, Mike Blake, co-founder of Experts Strategies. We're a boutique business and intellectual property valuation firm that also provides strategic advisory services, mostly to clients that are in the AI, data analytics, and SaaS space. And I'm glad to be here.
My name's Cordelia. I'm the other co-founder of High Score Strategies. I do marketing and communications, but today I am in the role of moderator. So I'm going to do my best to get to everybody's questions. First off, is there something about AI and SaaS startups that makes valuing them unique from other companies?
I take that. Yeah, AI is different. Just as SaaS itself was different, because initially when SaaS came around, everything was based on physical assets. And SaaS all of a sudden came around with something different. So valuing something like Google at that time was different. Now AI is different than SaaS because data, privacy, and access is paramount. Now, if you just build something on top of ChatGPT, for example, that's great. And guess what? In about a month, someone else is going to come and copy you. What's going to keep someone from copying you? So can you build a moat around what you're doing? So access to data, how you're training your application or your use case is very critical. And what's keeping your competitors from getting access to the same data and creating the same exact application? So what's the longevity of your application or your project? And that's what investors are looking for when they're looking at AI startups.
With this new AI technology, it's very tough to understand, and still we're just breaking the surface of what cognitive function is it replacing for human beings. So intangibles dominate value in this space, 100%. So the data, the models, the IP, the network effects, the speed of iteration and the learning velocity is more important here than any other sector you can think of. And one really important dynamic is a winner take all. This dynamic is something that is highly different because you don't necessarily need many different models. You don't need hundreds of different systems. you can build off of core engines that are now taking moats and basically taking data as that moat, as the new oil in the world, and saying who has the most access to data, clean data, collect data, it will now dominate this industry. And unlike anything we heard of before, the margin for this type of technology versus any type of human service in the past is so exponential. It's really tough to value it in the same light. So we really look at potentials rather than anything actuals.
I hesitate to say unique because I'm old enough now that I've seen things more than once, but it so much harkens back to the dot-com days in key respects. In the dot-com days, the market basically had a big argument about what the internet was going to look like. And I remember there was serious talk about retail brick and mortar stores going away, that nobody would ever walk into a store anymore. And that hasn't come to pass. But of course, e-commerce is big. It just took a turn differently than what anybody thought. And AI is exactly the same way. There's an argument now being held in the marketplace, and people are making billion-dollar bets on whether their argument is right. They're measuring their conviction in dollars. The other thing that makes it so much like the internet is that we're now building out massive infrastructure through the private sector to accommodate it. With the internet, it was about laying down fiber, to a lesser extent copper, and building services or pre-cloud, and eventually mobile devices. And now, of course, we have data center needs that are so big that we're talking about building captive nuclear reactors in order to power that. And there's talk of rolling blackouts in the United States. Just read about that today in the Wall Street Journal, because data centers are going to take so much energy. What's different about AI is that conventional valuation tools only take you so far because there's so many unknowns.
Now, in what ways are AI companies just the same as any other business?
Yeah, I would say that independently of which company you invest as an investor, you want to earn. So basically you say, okay, I have now $1 million and I want to make it $5 million in a year. In this way, you are still trying to see which company will earn. The ultimate question finally is that, okay, I want to have more money. I would say that for any kind of startup, for any kind of those who are searching for investment, the key message has to be, I know how to earn money. I found this like unique niche or the unique way how to earn money, and I need your money to earn even more. Basically, the formula is the same.
A lot of founders, a lot of startups that I came across with, usually the first thing I ask them is, what are you working on? What are you building on? I would say 10 out of 10 reasons, like in recent months, that will tell me, I'm building AI company. I'm an AI founder. I'm like, okay, tell me what it is. Are you creating a solution that really solving a problem, a critical problem in any sector?
How does valuation vary globally, and how can that either help founders, hurt founders? What can people learn from the global ecosystem?
The US ecosystem, a little bit more, they're more open to take high risk investment, like raising for like Series A. Sometimes US investors are more open to open the checkbook to invest in kind of like a concept without a full team. But the ecosystem in Europe is a little bit more like conservative, I would say. It's all relationship based. Same thing in Asia as well. It's like you want to meet someone, you want to get to know that person first, get an idea who that person is, then you talk business. In US, it's much more easier to open a conversation, but you do have to go through a different noise to find that. And also there's more grants and accelerator that give out, like even government grant that give out money out in Europe, in Asia as well. This is what I tell founders. We live in a global society now with airfare being cheap. You can literally find a one-way ticket from Beijing to Paris for 250 USD. It's not about the company itself, but it's more about you being in the city where everyone comes to town and you meet the right people.
I just did a whole 2025 report on valuation changes across all the entire world. And in AI, in the US, outside the US, some shocking statistics have come out of this. And in this report, the world pulled back a little bit from VC funding after 2020, after the pandemic. It hit a very low interest rates, which made borrowing capital very easy. And so a lot of investments grew really quickly. And this is how the numbers have changed. Last year, there were roughly if you measured US versus non-US deals, there's about 60% of deals that were non-US based and 40% that were US. However, the valuation, when you add up all the market value, 79% went to the US deals versus everywhere else. So what's happening is there's two dynamics here. Every country has a different currency, exchange rate, and a purchasing power parity. So for a company in that country to hire locally and to become successful, it's completely different cap tables or capitalization required than a company somewhere else in the world. We are more in a global world today than we were 10 years ago, than 15 years ago. And the access to capital for investors is becoming looser because no longer are we treating it as like we just in our backyard, we need to be close to the startups, we need to be right next to them to be able to help them out. We are in a digital ecosystem where people can invest and find gems around the world. So it's just opening. And for anybody who's in other markets around the world who don't have a lot of capital access, 100% you can go online to systems and find them.
The next question is from one of our attendees. What are some common KPIs that investors seek?
Here's the place where I think SaaS and AI do converge. They're still looking at the same metrics: cost of customer acquisition, long-term customer value. I think maybe the one thing that maybe is changing a little bit is time to market, because the market is recognizing it's going to take companies a little bit of time to incubate before they're going to get to market. But even that's compressing now. I defer to my other colleagues here on the panel, but I'm not sure there's a whole lot of change from what we're seeing in other businesses right now.
I would agree with Mike that the general idea is the same, that you have to make business finally. Yeah? What everybody says is that there is AI hype, but there is a lack of actual AI implementation and usefulness. Yeah. So if you show that you have traction, if you show that you have a real value, and if you show that as a founder, you can quickly switch and find new ways to make business. If your initial idea doesn't work, that's what everybody values.
It's very important to understand that AI isn't all the same thing. There are 5 different parts of AI. We look at infrastructure all the way to application. You have at the bottom level chips and NVIDIA and everyone building the actual GPUs themselves. You have data centers and using AI technologies and supporting that. You have model infrastructure. You have software infrastructure. So like chips, NVIDIA, data centers, Google data centers, and Amazon's. You have models like the LLMs that you use, DeepSeeks, GPTs. You have software infrastructure like Cursor and Claude Code, who are built in IDEs and MCPs on top of that. And now we have applications, everyday applications. There are different KPIs, all 5 different stacks, okay? They're not the same. And right now, a majority of people potentially in this call are not going to be touching chips and designing new NVIDIA chips, maybe not even data centers, maybe slightly touching models, but really are in the software infrastructure and the application. So I'll focus on the KPIs in those 2 spaces. Nothing in the world is new. We always repeat, we always go through cycle. If you study history, imagine where the world is going. What happened with AI is the exact same thing that happened with the .com era, which is allowing an infrastructure to allow companies like GoDaddy and Amazon to basically put out domain accesses, websites, and people build applications on top of that. The next major one was mobile phones. iPhone came out, infrastructure built on top of that. They had Xcode and coding tools, and applications were built on top of that. You follow the pattern, we'd have the same thing here. The base infrastructure was built, GPTs and what OpenAI has built was just an app store or an access to an app store. And now everyone's building apps on top of that. Right? Now, some people are touching the core infrastructure. So for those people who are touching models, cost per inference, model performance and improvement rate, data acquisition efficiency, human in the loop efficiency are really important KPIs. As you go away from the model infrastructure into software, we're starting to go back into SaaS metrics on usage, on how much is in, and then application, come back to the core KPIs of the industries themselves. How much time are you saving? How much money are you ROI in purchases to the customers this is? So you can traditionally at the application layer, look at anything that's currently in traditional industries and apply the same KPIs and make it successful. As you go deeper into the infrastructure level, you're changing now. And that's where the next new innovation and KPIs come from.
Okay, great. We're going to move on to the next question. How do I evaluate my startup before speaking to the first investor?
Okay, how do I evaluate my startup before speaking to the first investor? When you're speaking to investors, they want to know that you have done research, nothing else. If you're going in and say, hey, I have a really great idea, I haven't done anything to prove it, they're probably not going to be all that interested in you. So as an investor, I'm looking for what kind of traction do you have? Do you already have that, at least that first customer who is willing to pay for what you want to build? Do you have an MVP? If you do, how long, if you move forward, how long will it take you to prioritize it properly? What kind of customer profiles are you looking for? When I hear people say something like, oh, my TAM is 100 billion, I was thinking, okay, that's great, but how much of that is reachable TAM? Because you may only be able to reach 1 million of it, and then it may not make sense to move forward. So all those due diligence questions, I'm sure Mike probably has a whole spreadsheet of these things that he goes through with clients.
Pre-investor. Like a lot of founders, they don't really realize that investor relation is a long game. You're not going to go out there and see someone that, hey, I'm building ABC and I need your money, open your checkbook. No. The investor are looking for like a founder that can come in to build a long-term relationship. So when I talk to founders, I will tell them, make sure you have all the metrics. Don't just have an idea and go out to raise. Do your homework and have a team. It's okay to be a solo founder. You need to have your board advisor, have a couple of people that skill in the sector. You're going to have a better team to show on the team page. Another thing is when you talk to investor, always have a one pager.
I'd like to add here that your valuation of the company on the first stages is very subjective, because actually you don't have anything real yet, and we went through the business model, which had to finalize to summarize the valuation and amount of money of return of investment that investor will get in basically 2 or 4 years on the next rounds. Because again, everybody wants to earn. You cannot promise because it is a risk, but it looks like you will earn at least maybe 60-70% of a yearly revenue. That might be interesting because it is more than you can get on the S&P. But if you say, I will build something that in 4 years will bring you to the 20% of yearly return on investment, then investor will say, yeah, it's only your promise. It will really be even smaller. Why do risk with you if I can go to stocks, to crypto, to whatever, yeah? So basically, you have to try to build your strategy and prove this strategy to investors.
What is the impact on the costs of data going to be on these valuations?
I actually happened to read an article in the Wall Street Journal today, and it showed this fantastic chart. It illustrates electricity demand in the U.S. increasing rapidly during the advent of the dot-com industries, then flattening during the 2000s. As electricity demand basically just matched population growth. And now electricity demand is already skyrocketing and was expected to take off. And it's already leading to higher electricity prices in some localized markets. One of the important KPIs is going to be the price of compute, because right now, a lot of us can access AI platforms, don't have to pay anything for it. Just like we didn't used to have to pay for grocery delivery. We don't used to pay for a lot of things in the dot-com era until we did. I think in the next 12 to 18 months, that users of AI are going to have to start paying the actual resource cost to generate it.
We're doing a lot of budgets for our large language models on this. And I have moved our models to NVIDIA servers here in Canada that are live right now. And it's going crazy right now in terms of cost. Like, to echo what Mike was saying, it is getting worse over time. But however, one thing that I'm optimistic about is decentralized computing. I'm realizing that there's a cap of how much utilization we can hit with this technology in the short run before energy systems and infrastructure get better and faster, which is already happening, but not fast enough. It's also now a societal question, right? With rolling blackouts and some of the world don't have energy access. Is AI, it's a moral, ethical question. Should it go towards this technology to solve small, medial tasks? Or are we moving away from something that's more of a societal good? Just as a question to keep out there.
On the final part of the question was whether it will affect valuations of the AI. And I think if we're speaking about the startups, I think it will just finally come down to the same, like how much revenue do you get and how much do you have to pay for the tokens that you use in order to deliver it. And as Nesh mentioned, that from one side, it is getting more expensive, but from another side, there is an optimizations all the time ongoing. So they might balance out each other a little bit, like Mike mentioned before, how it works with electricity. On top of this, I think that considering unfortunate geopolitical events and focus of last years on the war technology, it will become more and more local. I think they shouldn't rely all the time on the one remote data center, which you can switch off and all the technology will stop. So there will be a big boost in the development of the local AI, which is very energy efficient. So I think with these technologies being more and more developed, the actual cost and actual energy usage will be lower. And with some kind of spikes ups and down, it will just balance itself and go and be more efficient.
We have another question here from somebody on the audience. How do you include time for an entity to develop responsibly and sustainably in your valuation profile?
This is a fantastic question. And I don't even think the jury's out for this yet. It's still, when you look at how other firms around the world are looking at ESG and DEI metrics and how important they are now in these decisions, like what Alex said about geopolitics, we're all directionally going in a world of climate sustainability and growth with metrics. And now in the past 2025, I think we got derailed a little bit from that. And the value of building that is changing. I think as of right now, what responsible and sustainable will be considered locally or sovereign. What can be protected? What countries can utilize themselves and keep out from others? The currency of the future is trust. And the trust is what AI is now being looked at, is where it's coming from, what sources, how it's been built. Have they followed ethical codes? Have they done human in the loop in the models, right? And all of those influence valuations. Why? Because it creates a risk. Right now, the world's looking at trust. The future is not technology alone, it's trust and who can build a trusted system.
Our next question comes from Walt Sopranov in the audience. In the dot-com days, an investor's role was that prudent investment in dot-com startups was stock, not cash, because of high failure rates. Do you agree with this? And would you say the same is true of AI?
Yeah. Hey, Walt, thanks for coming. Good to see you, at least virtually. I don't think that's the case because I think that the market is so much of a seller's market for sellers of stock for the AI companies right now that they only want stock if they're forced to. What they need is cash to build their footprint, to build out. Now, might they take stock in a company if that company then is going to also provide the cash to help scale that company? Then yes. I think right now cash is king because the successful AI startups have a lot of market leverage right now.
We have a question from Christiana in the audience. What holds more value, being in a market with cutting edge tech or in a market where people actually use it?
Oh, what a great question. When you're looking at valuations, all the top 10 AI companies in the world, do not look at them. There are other things going on behind the scenes. There's government grants. There's other types of liquidity at play that the valuations are not at. Where it becomes hard to calculate is when geopolitics come into it, right? A country is investing into its AI infrastructures in order to protect its national security. When you do it that way, or when that's the way the world is going towards, it's hard to determine what the true valuation of something is because of the fact that the infrastructure doesn't really make money till later on. So you need users on the infrastructure to make money. Will OpenAI retrieve all the money that they put into to building these centers? Probably not. I believe that unless you're first to market in this, unless you have massive billion-dollar investments, you're probably not in the infrastructure. You're probably in the application. And being in a market with cutting-edge technology that is being used is really important to meet exits, to meet TAM, to meet growth. But the initial build phase, you want to show your intellectual property and the numbers grow. Very hard question. We still don't have the answer to it yet, but what's trending, to leave you on this point, the trending direction is always in a gold rush. There's always money to be made in building the picks and the shovels and the gold, then harvesting the gold itself until a certain point in time where everybody can build picks and shovels, then the gold becomes much more valuable.
I look at it from a valuation perspective. For me, adoption is a lot more important because cool technology comes and goes over time. If no one's using it, it's still garbage. When I'm looking at a company or I'm looking at an idea, someone comes up with a really cool technology where someone else is going to come to me and say, hey, I got 500 people using it and I will market it to 1,000 people. That's really great numbers. So at the end of the day, that's what's really going to matter to me.
Monetization is so important. And sometimes it's really hard for founders because they're so passionate about whatever the cool thing is that they have that they don't have sight of monetization.
Yeah,
That's for
lots of
sure.
people forget about distribution. Distribution
Yeah.
is, it's not sexy, but that's what actually spills.
We have a question here from Charlie Cicchetti. When talking to strategics that may be interested in acquiring, what tips do you have for due diligence and NDAs?
Hey, Charlie. Yeah, look, this is really a legal question. I think first and foremost, it's not unique to AI. Anytime you're going to show an invention to a company, you're going to take a risk. As Ash said, nothing's ever new, and this question is not new. Make sure that you do your own due diligence on your potential partner, right? Do they have a habit of being sued by other inventors? I wish I could tell there's a magic bullet for this. I think whatever you would use in a conventional sense applies in the AI software space as well.
One point I want to highlight that Mike made is that a lot of companies, especially smaller companies, really feel like NDAs protect them, but they really don't. If Microsoft breaks your NDA, there's nothing you can't out-lawyer Microsoft. So it really does come down to what Jessica was talking about, trust being the currency here. Litigation is expensive, even if you win. Let's put it that way.
I can give out some example. One of the big social enterprise that I know, the founder have meetings doing some at Amazon. The partnership, the negotiation didn't work out, but Amazon come back and starts copying them. Go around, ask people that you trust, people that you know, your network about this person. And it's a long process that you gotta have to, because it can cost you a big investment.
So I just filed 2 patents in AI logic, and I had to revise the patents because of the scope of what was available online for anybody else to see. There's something called moats, okay? That's IP, that's defensible, that's yours, that you only have access to and nobody else has access to. What should be showed without getting under the hood is a Eagle 3000 level stack analysis of what stacks of technology you're using, so that people on the investor side understand you're using the right tools. Really, to answer this question, well, what do you want to see in due diligence on NDA or not NDA is outcomes. If you can start to show evidences of results of this system, don't worry, there's a magic in there. We're not telling you yet. You have to sign a letter of intent or a term sheet to get information rights to that, because that is the secret sauce. And if an investor asks you, give me that information, say, honestly, unless we have something, and you wouldn't want to give that to other investors after you sign, you want to make sure to follow that same process. So having a strict investor process means create 3 levels of information in your IP. 1, in your pitch deck, anybody can know high level stuff. Number 2, once an investor has interest, your stack, your architecture, your know-how, and your outcomes. Once they've signed that, they're an information right investor, they have access to everything, you're under close, you can show your model weights, your data, the actual infrastructure, what's connecting to what, and where your data sources are coming from. You do not want to submit to anybody before.
It was like 2 or 3 years ago, I was talking to a lawyer about a business, and I also wanted an NDA, and he just laughed at me. He said, "You guys still do that?"
After raising capital, how do you decide where to allocate those funds? And I would add to this, when do you decide how to allocate those funds to drive the most growth and value creation?
You have to have a strategy of your growth. Yeah, that's the key. You have to build to your future, and you have to say, okay, out of those potential areas, where do I have most result in the future? 2 questions that I would ask myself when building the strategy is, how can I maximize my real value? Like not the hype person, not this, but the real value that I'm bringing, and how can I maximize my long-term real value? And if I allocate resources there, then to bring hype on top of it and all that stuff, that's easy. One thing though that I would not do, I wouldn't go full money in one direction without getting preliminary confirmation that direction will bring me money. I would allocate a small amount to verify that this direction is actually profitable and will bring you the result that you want, and only then allocate it there.
I'll answer it another way, and it's probably not answering the question you were asking, but as an investor, this is the question you need to have answered before you take my money. If you don't know what you're going to do with my money, I'm not getting my money.
Think about a business as a full circle, right? You get people coming inbound in the funnel, you get them treated, converted, sold to, kept around, or expanded, and either they leave or they stay. It's a massive formula. It's money. It's not a charity, right? You make money on the business. what you should do is understanding where you should allocate funds is map out every step of your process from the top of the funnel where you're meeting people and leads all the way to the end and see the average industry rates at every stage. Wherever you see yourself fall from an industry average and you cannot justify why that's different, more than likely you need capital there allocated to loosen up the funnel. A great company is when you are above market average on all stages of the funnel. You're bringing in lots of leads, you're converting them, they're staying around and growth. And so there's an offense, which is sales, marketing, upline. Then there's defense, it's product, customer service, quality assurance, AI model. If you think your soccer field or football stadium and your sales team are in the front scoring and the back of the defense team, you can look and realize where are you weak in terms of your line of players and how do I distribute my funding so that I can alleviate that. So if there's A's across everything except two categories that are C, I will look at my percentage of funding in total. I'll allocate slightly more to those areas than everything else, which will hopefully alleviate the conversion rates or the metrics over there to go faster, bring us to industry average or above industry average, and then move on to the next problem to solve.
I'd like to share a statistic that I heard on Scott Galloway's podcast last year that just floored me. What he said is that 40% of venture funds raised in the United States are spent on three places, right? Meta, Facebook, Alphabet, Google, and Amazon. You want to think about where money's being spent. 40% of it, statistically speaking, out of the gate is going to those three places. I believe in the wisdom of the markets, right? Investors don't have a lot of appetite for investing in science projects.
I can share some examples. So I do know there's a company out in New York that raised a big amount of money and they pretty much spent all the money into throwing parties at the Hamptons. And after a while, they all get in trouble. So you have to be wise of what kind of person you're going to bring in to help. And also always leave some money behind and spend it off for emergency because you might need some cushion for the rainy day. So,
All right, we're going to have two more things. So we got one more question I'd like you all to each answer. And then you guys can each give closing thoughts. We've had a great audience here, and so we want to respect everybody's time. So the final question is, what are the most common valuation mistakes founders make? And I'd like you each to comment on that. Mike, can you go first?
The most common mistake is they assume that just because a company raised money to a certain valuation, it looks like them, that they're entitled to that same valuation. And they may not be because they only know about 5% of the material facts that went into that valuation. And it leads to some unrealistic expectations.
Alex, what do you think are the common valuation mistakes founders make?
I would say being unrealistic in their prediction of the sales of the money flow they have and do their valuation based on this unrealistic expectation, which gives as a result unrealistic or wrong or not getting at all investment.
Say don't take more than you need because this is not free money. You're giving something away. Well, eventually they're going to come back to collect. So only take what you need at that time.
Kick out the valuation to Series A or later, where you have more data and more information. Understand that for any investor, at least before Series A, you can push out the conversation. Anything before that, the common mistake is trying to create one that you think is right.
idea stage, pre-seed, early stage company is really hard to find out how much it worth because everything is based on idea. I highly agree with Ash. And also stay grounded. And a lot of founders make a mistake by having high valuation. But then again, when they get the funding, investors come around, it's okay, they're not who they say they are.
So to wrap up, can each person just say a little bit about what kind of resources you provide and if you're looking to make connections with people who you would like to meet?
Yorkseed is a global venture network for founders investors. We have different hubs around the world, US, Europe, Asia, Middle East. We also have a conference hub. So at the end of the day, Yorkseed is going to be a platform for investors. I'm trying to bridge the gap between founders investors globally that I think everyone needs to be a bit more open-minded where you can get deal flow and money from. It may not be the city that you live in right now, but just pay attention. We have a lot of resources and we have a bunch of people out there in Switzerland right now for the World Economy Forum.
Yeah, Yorkseed has been an amazing community. I can definitely vouch for just an incredible group of people it's been. Ash, can you tell us a little bit about your thing and what kind of resources you provide and who you're looking to meet?
We designed an SCT Moody's type tool for investors to ingest pitch decks, websites, data rooms, financials, cap tables, and automatically convert them into risk ratings like Moody's scores, provide valuations to companies, and to be able to run syndication and cohorts from LPs. So if you're a company looking to learn more about yourself, but actually connect with investors, now we have many big VC funds around the world using us. And sometime in the next couple of months, we're launching a new stock exchange called Global Startup Exchange, where now everybody can raise their capital globally from any investor on the planet. So if you're on the investor side, a family office, corporate VC, LP, we've built the smartest, most sophisticated due diligence system on the planet, which will help you reduce costs and improve rate of returns for your fund.
I run a hedge fund, and as of February 1st, we're accepting money. The hedge fund is mainly focused on U.S. markets, broad market. It's cool. And yeah, we're raising money. So if you know anyone who is interested in investing, let me know.
Okay. Do you have a minimum amount that people need to invest in order to be considered?
It's 500,000 right now.
I have two sides. One side is I'm helping mentoring consulting startup on strategic topics, all what we have talked today about, and like helping them to make the strategy, to present themselves to investor. And another side is that I am now building a platform to help to do all this in the automated way.
I just want to say to the people in the audience, when Jal is in Cascais, Portugal, Ash, are here in Toronto. Mike and I are outside of Lisbon, and then we have Jessica in Paris and Alex in Barcelona. It's a pretty amazing global expert panel that you have here today.
The resources you provide are knowledge to help founders understand how to optimize the value of their companies and then build strategies around value. Who I want to talk to is startup company founders and those who love them. And that may be investors, maybe other founders, could be advisors. I see my role is to try to be a connector. I want people to reach out to me if there's a possibility I can help do that.
I want to thank Jessica for giving us this opportunity today to share with everybody and be resources for each other, which I think is how we all grow and hopefully someday how we fix this geopolitical situation in the world. Thanks again, everybody, for being here, and have a great evening, afternoon, morning, wherever you happen to be.
Thank you.
Thank you.